Hello everyone and welcome back to the lesson. The subject is advanced taxation. We continue with the topic taxation of cross-border activities. Our today's focus is on tax havens and treaty shopping. Tax havens. So in this lesson we will study the characteristics of tax havens and treaty shopping. We will look at the reasons for using tax havens. Why do companies or individuals opt for tax havens? And 3, we will highlight the criticisms and concerns of tax havens and treaty shopping. So let's begin with tax haven. What is a tax haven, or what are tax havens? Now, tax havens are countries or jurisdictions known for their favorable tax laws and financial secrecy. All right? Tax havens are just countries where there are no tax laws or very low tax laws, low or zero taxes. Without an E here, it's just haven, but when you put an E, then you have heaven. All right? It's a place, a country, a jurisdiction where there are low or zero taxes. These are countries where there are favorable tax laws, where there is favorable financial secrecy, and such jurisdictions attract businesses and individuals and also entities that are seeking to minimize tax liabilities. Such jurisdictions attract individuals to protect assets and maintain financial privacy. These are locations often known for their low or zero tax rates on certain types of income, alongside a very lenient regulatory environment and high levels of financial confidentiality. So what are the characteristics of tax havens? Characteristics. I already mentioned a few. In defining tax haven, I've mentioned a few characteristics. And one is low or zero taxes. Low or zero taxes. Tax havens typically impose minimal or no taxes on specific types of income, such as corporate profits and dividends, interests, or even capital gains. In defining tax havens, I also mentioned financial secrecy. Tax havens are known for financial secrecy. They have strict banking and corporate secrecy laws. Okay? Secrecy laws. Very strict, stringent financial secrecy laws. You understand? And they often allow even anonymous ownership or beneficial ownership of assets. And that makes it challenging for authorities to trace assets or incomes. These are countries where you can own assets or bank accounts anonymously. They have strict banking and corporate secrecy laws that allows anonymous ownership or beneficial ownership structures, making it challenging for governments or authorities, tax authorities, to trace assets or incomes. 3, the third characteristic in relation to tax regulation. Tax regulation. Tax havens often have minimal regulatory requirements, which provides an environment conducive to quick and straightforward company formations with fewer reporting obligations. Minimal tax regulations. 4, non-transparency. Non-transparency. There is limited disclosure requirements, all right, which can make it challenging for tax authorities and international bodies to assess information about financial transactions or even ownership structures. All right? Non-transparency. Limited disclosure requirements. This means limited disclosure requirements. Non-transparency. So these are characteristics of a tax haven. The next question we need to answer is the reasons for using tax havens. Why do individuals or companies use tax havens? And your reasons will be as good as mine. The first reason, obvious reason here, would be tax optimization. Tax optimization, number one. Businesses and individuals may use tax havens to legally minimize tax liability by structuring their finances in such a way that takes advantage of favorable tax laws. That's the first reason. Number two, asset protection. Asset protection. Some tax laws or havens, some tax havens may be used by individuals to safeguard assets, to maintain financial privacy, and also protect wealth from legal claims or potential creditors. Hiding. Individuals or companies can use tax havens to hide assets, to hide wealth, to protect wealth from legal claims or potential creditors. Number three, we are outlining the reasons why individuals or companies may use tax havens. International business operations. International business operations. Corporations might establish subsidiaries or even entities in tax havens in order to facilitate international business transactions and manage global finances efficiently. 4. Estate planning. Estate planning. Individuals may utilize tax havens for estate planning purposes, including a trustee or other structures to manage inheritance and also minimize estate taxes. So these are 4 reasons for using tax havens. Criticisms. Or concerns. The first criticism or concern relating to tax havens is tax evasion and avoidance. Tax evasion and avoidance. Tax havens can facilitate tax evasion by allowing individuals or entities to hide income or assets from tax authorities, and that raises concerns about fairness and also the erosion of tax revenues in the country. 2. Illicit activities. Illicit activities. The secrecy and lack of transparency in tax havens can facilitate money laundering, can facilitate illicit financial flows and other financial crimes. The third criticism is in relation to tax justice. Global tax justice. Tax havens are criticized for contributing to global inequality by enabling the wealthiest individuals and corporations to avoid paying their fair share of taxes. And efforts by international bodies such as the Organization for Economic Cooperation and Development and individuals, countries may have the aim of combating tax evasion and increasing transparency through initiatives like what we call the common reporting standards and also the exchange of financial information between jurisdictions to mitigate the adverse effects of tax havens. Do you understand? Tax havens have been criticized for contributing to what we call global inequality by enabling the wealthiest individuals and corporations to evade or avoid paying taxes. That's why we have organizations like the OECD, the Organization for Economic Cooperation and Development, whose activities aim to combat tax evasion and increase transparency. Global tax justice. All right. So we now move on to the second part of the lesson, that is treaty shopping. Treaty shopping. What is treaty shopping? Now, treaty shopping is the practice of exploiting tax treaties. It is the practice of exploiting treaties, exploiting tax treaties to obtain preferential treatment in a country other than the taxpayer's country of residence. Do you understand? Treaty shopping is a practice of exploiting tax treaties, and the purpose for doing so is to obtain preferential tax treatment in a country other than the taxpayer's country of residence. And it often involves establishing a shell company in a tax haven jurisdiction to take advantage of the treaty's benefits. So a resident company in Kenya can engage in treaty shopping by establishing a shell company in country C. That is where country C and country Kenya have a tax treaty. So the purpose for treaty shopping is to obtain preferential treatment in country C, which is not the resident country of the taxpayer in Kenya. So it is simply taking advantage of tax treaties, exploiting tax treaties to obtain preferential tax treatment. And candidates, tax treaties are agreements between two countries that aim to prevent double taxation and facilitate cross-border investment. However, the provisions of tax treaties can be exploited by taxpayers who seek to artificially reduce their tax liability. So treaty shopping typically involves 1. Establishing a legal entity in a tax haven. So the taxpayer or business establishes a legal entity such as a company or a trust in a jurisdiction with low or no taxes, or where there is limited exchange of tax information. Then the company then structures its transactions through the tax haven entity. Taking advantage of the treaty's favorable tax rates. Then the next thing is to claim treaty benefits. The taxpayer or business claims the benefits of the tax treaty between the tax haven jurisdiction and the country of residence, thereby reducing their overall tax burden. That's how businesses or organizations or individuals take advantage of tax treaties. Treaty shopping. Treaty shopping. Now, candidates, just like tax havens, treaty shopping have been criticized. There are also concerns around or surrounding tax treaties. I mean, treaty shopping, criticisms or concerns. And one concern is in relation to loss of revenue. Revenue loss. Number one, revenue loss for governments. Revenue loss for governments. Governments lose tax revenue when taxpayers shift their profits to tax havens through treaty shopping schemes. 2. Erosion of tax base. Erosion of tax base. Treaty shopping can erode the tax bases of countries by reducing the amount of taxable income that is reported and taxed domestically. 3. Undermining of tax fairness. Undermining of tax fairness. Treaty shopping can undermine tax fairness by allowing certain taxpayers to pay lower taxes than others, and thereby creating a sense of inequality or iniquity. Four, treaty shopping can facilitate tax evasion and avoidance and tax avoidance. Treaty shopping can facilitate tax avoidance and evasion by providing means for taxpayers to conceal their income or assets from tax authorities. 5. Distorting investment decisions. Distorting investment decisions. Treaty shopping can distort investment decisions by encouraging taxpayers to invest in tax havens for tax reasons rather than economic considerations. So these are 5 criticisms against treaty shopping. We outlined 3 criticisms against tax havens, and that marks the end of our lesson, where we again highlighted the characteristics of tax havens and reasons for using tax havens. So I'm going to give you revision questions. Number 1, what defines a jurisdiction as a tax haven? And how do these jurisdictions attract businesses? And what are the primary characteristics that distinguish tax havens from regular tax jurisdictions? Number 2, how does treaty shopping operate within the context of international taxation? 3, what are the strategies used by businesses to engage in treaty shopping, and what impact does it have on global tax systems? 4, how do countries and international bodies respond to tax havens and treaty shopping practices? 5, what measures are in place to curb the negative impacts of these practices on tax revenues? Another question, what ethical and legal implications arise from businesses engaging in treaty shopping or using tax havens? And lastly, how do these practices align with global tax compliance and ethical standards? Thank you for attending the lesson.